Good to have you with us. Thanks for tuning into another episode of Investors Guide, a show where we guide you and help you on how you can make your money work for you. I'm Avni Raja. On the show today, we are going to be talking about the Reserve Bank of India's latest proposal or new rules that it's going to put in place to allow investors to get direct access or to directly be able to buy and sell government bonds. Now, this is something that was not possible earlier. Earlier, you had to either go through the stock exchanges or you had to go through mutual funds to try and access or to get to buy these government bonds. But now the Reserve Bank of India has said that it is going to make it simpler and directly allow investors to buy these government bonds. Now, this is important because India becomes one of the very few countries in the world that actually allows this. In fact, it's the first country in Asia to take this move. And it's also going to help investors, to add to their portfolios in a much more easier manner as far as the debt portion of the portfolio is concerned. But to understand how this is going to work and what this really means, joining me is Feroze Azeez of Anand, Rathi Wealth Management. Feroze, thank you so much for joining us on Investors Guide. This entire, move to allow direct access to government bonds for retail investors is going to come as a big step forward for India at this point in time. If you can first help us understand how this is going to work.
Yes, Avni, it's a very big step because allowing retail investors to participate directly on the RBI platform is a good progressive move. Why is it important? Is because today what happens is a person who does not have 5 crore plus cannot operate in the bond market segment so easily. So people use the mutual fund route, which automatically the NAV has the volatility. Even if the person wants to hold the bond for 5 years, he has to go through the ups and downs of the NAV. So it's a big move, point one, because we are one of the few countries who allow retail participation directly. Point two, we as a country have a very large savings rate. 25% of GDP is our saving rate, which is greater than $500 billion. So GSEC is not getting a lion's share out of the saving rate. So I think that's the key catchment area which the RBI is eyeing. And how this would work, unlike in the past, Avni, is today what happens is retail participants are allowed to go through National Stock Exchange and the Bombay Stock Exchange. There's a platform available which is called the Go Bid, in which a retail investor can actually participate, but that's a very lengthy process, not so logistically friendly. It is low on volume, so they don't discover the price and get the fair price. And liquidity and pricing becomes a key issue on the current available indirect NSE platform, BSE platform based subscription.
Right. So now once this comes into play and once this entire system is implemented, what would be the kind of benefits that an investor would get? Because earlier on, obviously, like we've also talked about the fact that there's not enough liquidity in the entire market in the current system. So what's going to change and how is it going to benefit investors and overall the system?
Avni, I think a lot has been spoken over the last few days after the governor mentioned this. But I think the fine print is awaited. In my opinion, if the fine print and the details can address 2-3 key issues, is when this will be a success. One key issue is the market making. If you get a retail participation in a GSEC kind of an instrument, it's important for that person as a retail investor to get liquidity at fair price, and that happens if there is a market maker. Just like in exchange traded funds, there is a market maker. If the detailing of the scheme provides for a market maker, it will be a big win. Second, I think it's also important for the retail investor to be able to bid, which is mentioned here, but I think the detailing there also is very critical. Thirdly, GSEC has several kinds of bonds: 1 year, 3 year, 5 year, and 10 year. So if a person could marry his liquidity requirement precisely with the bond he is buying, then he does not have to worry about the interest rate risk and the volatility at all, as long as he can marry his requirement of investment and the bond.
Right, and obviously, we're still awaiting a lot of details and clarity, like you pointed out. But nonetheless, if there is something or some points that investors need to be aware about, or perhaps certain challenges that even this system could pose, what would you say they would be?
See, what would be the major challenge or a disadvantage of participating directly in the government securities, at least in the current scheme of things, is taxation. Because when you go through a mutual fund platform to buy the same security in the form of a GSEC fund, you get tax efficiency because you have long-term capital gains and indexation. If RBI actually gives some credit in terms of tax advantage to the scheme, it'll actually fly very well. So to answer your pointed question, Avni, interest rate risk and the volatility associated with interest rate movement is one thing which a person has to be very careful about. Also, the second thing he or she needs to be careful about is if they are in the highest tax bracket, this is not a great news for you. If you are in the brackets of 20% and lesser, then this becomes an attractive alternative. So these are the two most important points. And third, and the last one, is to marry your liquidity requirement and always have an objective of buying the bond with a clear condition of holding it till maturity. If these three things are taken care, then it's a very cost-efficient mechanism. Unlike in a mutual fund, you will have to pay a management fee. Here, there's zero management fee, and people can capitalize on the high interest rates which India has to offer in relation to the rest of the emerged economies.
Yes, absolutely. And it's also an extremely safe way to invest and an easier way to invest as well for all of those who are risk averse at this point in time. But Feroze, also there are at this point also a lot of details still awaited from the Reserve Bank of how this is actually going to work, how investors will be able to open, gilt accounts on the platform which the RBI is going to oversee and overlook. What are these key details that we still need?
One thing which is very important whenever it comes to targeting retail investors is the operational ease. There are so many schemes which are there for retail investor, but they're so complicated to actually execute or liquidate or make changes. Like the NPS, for example, it is such a good cost-efficient platform, but it's so complex to open an account and operate it that retail investors shy away. So I think the operational details and ease of execution will be the key determinant of its success. The second thing which I would be looking for, like I highlighted, is the market making, which is important for the liquidity and the pricing to be fair to a novice investor like a retail investor. And the third thing which I would be very eagerly looking forward to is to see whether there would be a same kind of tax treatment to these bonds like it is there for a mutual fund. So I think these are the three key very important things which I would be looking for.
All right, Feroze, thank you so much for joining us and putting all of that into perspective. Of course, it is going to be the fine print of this entire new system that's being put in place is going to be very eagerly watched and eagerly awaited. And we'll, of course, continue to track all of those details for our viewers as well. On that note, that's a wrap on this edition of Investors Guide. Thank you so much for watching.